Hey everyone, Assalamu alaikum. Welcome back to T Accounts. So in this video, we'll be solving June 2024 paper 12, which is of 1 hour, and we have 30 questions in it. So let's begin. The first question says, which statements relates to a sole trader? Right. Number one is the business is a separate legal entity. No, this is not right, because separate legal entities, this benefit is only for companies, not for sole trader or not even for partnership businesses. So this can't be right. We know that sole trader and partnership, they both are not considered separate from the business, from the sole trader and from the partnership business. They both are treated as one. So that is why they have unlimited liability that they have to pay on behalf of the business in case the business fails, in case debts fall due. So separate legal entity, this benefit is only for companies. So this is not true for sole traders. So this can't be right. Then there is no separation between ownership and control. This is true, as the one who owns the business, who owns the sole proprietorship, also is the one who is controlling, who is managing the affairs of the business as well. So this is true in sole trader, because in companies we know that managers are hired, directors are hired to manage the day-to-day affairs of the business. So ownership over there is of shareholders, and the control, the management, is in the hands of the directors. So this is correct for sole traders. Third is, most of the profit is used to pay interest on the owner's capital. No, there is no such requirement for that. Interest on owner's capital, that is usually done for partners in partnership business, when interest is payable on capital, on their capital investment, to encourage them to do not, so that they don't withdraw their investment or that it remains in the partnership business for a longer time. But that is a reward for the partners. There is no interest on capital to the sole trader. So that is not true. Number 4 is, there is no legal requirement to keep full accounting records. Yes, this is also true. Although full accounting records should be kept for better accounting purposes, but there is no such legal requirement, right? The word is legal over here, which is important, because the legal requirement is for companies to maintain proper full accounts, as it has to be published. We know that companies, the financial accounts, the financial records are published yearly. There's a legal requirement for that, but not on sole traders. As sole traders have more privacy as compared to companies, so they can maintain full or partial accounting records. So 2 and 4 only. D. Question number 2, which item incorrectly applies the matching concept? So the key word here is incorrectly applies. So this means that in 3 options, matching concept would be correctly applied, but in the of course in the answer that we are looking for, it will be incorrectly being applied. So matching concept shouldn't have been applied over there, but it is being applied. So let's start from option D. Option D says, recording telephone costs incurred but not yet billed. So we have incurred an expense, we have used up an expense, but we haven't paid for that expense. This is a correct application of matching concept. This is how it should have been done. This is how the telephone cost should have been recorded, as the matching or the accrual concept says that even if you have used an expense, even if you have incurred an expense, please record that in the statement of profit or loss, irrespective of its timing of payment. Right? So this is correct. C is providing for irrecoverable debts in the year the sales took place. Yes, this is also correct application of matching concept, as matching says to match your current year revenues with your current year expenses. So since a revenue is being recorded, that is in the form of sales in the current year, an expense against it, if there is, in the form of irrecoverable debts, or even if in the form of allowance for irrecoverable debts, should also be recorded to match the revenues with the expenses in the same year. So this is also an application of matching concept. B is including a value for unused stationery in the statement of financial position. Unused stationery, we know that stationery is an expense, and if we are not writing off all the stationery that is being used in the current year as an expense, we have some unused stationery that can be recorded in the statement of financial position under current assets. So this is again a correct application of matching concept. This can be done. Now this leaves us with option A only, which must be an incorrect application of matching concept. It says, capitalizing staff expertise and writing it off over the working life of the staff. This we can't do because staff expertise is something which is non-monetary. We can't assign a correct value to this asset of the business, as it is a subjective matter, right? In case of non-current assets, we know its cost. The cost is a fact. That is what we are paying against the purchase of non-current assets. So that is how we write it off. We write off the depreciation every year to record an expense against the use of the non-current asset, and that is how we distribute its cost. But that cost is already known to us, right? That is the purchase price of the non-current asset. But how do we arrive at the monetary value of your staff expertise? This is very subjective. So such application is not permissible under matching concept or any other concept. So this is an incorrect application of matching concept. Question number 3 says, very easy. Goods that had previously been purchased on credit have been returned to the supplier, right? So we purchased goods on credit, we are now returning that to the supplier. So this means that purchases or sales returns. This is purchases returns. Then further it says, how should this be recorded in the purchaser's books of account? The one who is purchasing the goods is the same person who is now returning the goods to the supplier. So again, he must be recording purchases returns. How this should be recorded? Whenever there are purchases returns in the business, purchases returns reduce the inventory in the business, so purchases returns are always credited, and on the debit side we debit the supplier to show a decrease in liability, as we won't be paying now for the goods that we are now returning. So supplier is being debited to show a decrease in liability. Where can I find this option? Supplier debit, that is trade payable debit. Trade payable is being debited here, but bank is being credited. No, bank can't be credited because the purchases were on credit. So trade payable debit and purchases returns credit, option C. Number 4, Jason sold a non-current asset with a carrying value of 8,000. What is carrying value? Carrying value is the net book value. So that at the time of sale, the net book value of the non-current asset was 8,000. What did he do? He mistakenly recorded this by debiting the bank account and crediting the sales account with the proceeds of 6,500. Okay, so he should have debited bank. He is correctly debiting bank, but instead of crediting the disposal account, he incorrectly credited the sales account with the sales proceeds of 6,500. By which amount? The question is, by which amount the profit for the year was the profit for the year overstated? Right. So what did he do? He first of all recorded this transaction as sales. So he credited sales, and by crediting sales, he increased the sales by how much? By 6,500. Sales increased by 6,500. If sales are being overstated, my profit will definitely be overstated by 6,500. Then secondly, since he did not record this in the disposal account, so there would have been some error in the disposal account as well because of this error, right? So let's prepare the disposal account. The net book value of the asset being sold is 8,000, so let's record that on the debit side. If the cost is given, so we record the cost on the debit side. If the accumulated depreciation is also there, we record that on the credit side. But if the net book value is just given, so that is a net figure, we record the net book value on the debit side, and that's it. We don't record the depreciation separately then in the disposal account. So he received 6,500. 6,500 disposal proceeds, bank debit, and disposal account should have been credited. But since he did not do that, so he did not record a loss of 1,500 in his disposal account, right? He did not do that. He did not record the loss of 1,500 in his disposal account. So that would have also affected the profit. This was the first effect. What is the second effect? Not recording a loss. Not recording loss of 1,500. That would have also overstated my profit by 1,500. So in total, my profit would be overstated by 8,000 because of the error, right? Option D. The first effect, recording the sales proceeds as sales, sales were overstated. Not recording the disposal proceeds in the disposal account resulted in not recording the loss of 1500. So the loss would have reduced my profit, but since it was not recorded, my profit would again be overstated by 1500. Question number 5. The question says Adam's financial year ends on 31st December. At the beginning of the year on 1st January, the carrying value of machinery was 20,000, right? Again, net book value is given to us. So the opening net book value is 20,000. Now what happened during the year? During the year on 30th June, right, after 6 months, he purchased a new machine for 6,000. The price of the new machine is 6,000. He paid 50% of the cost in cash. So 3,000 would have been paid, and the balance by part exchange of an old machine which had the carrying value of 2,500 on that date. On that date means on 30th June. Now let's read the policy of depreciation. He depreciates his machinery by 20% per annum on the carrying value calculated on a time basis. So this means that reducing Dunni's method and monthly basis of depreciation is being charged. So before reading the question, let's summarize what is the situation in Adam's financial statements. He purchased a machine during the after 6 months, right, on 30th June, and on the same date he disposed of, or should I say he part exchanged against the new machine and old one, and the old one had a carrying value of 2,500 on that date. So does that mean that on this value, what does this represent? Does this mean that this value represents the post depreciation figure for the current year? Does it mean that this has already been depreciated in the current year for 6 months? Yes, it does, because the question says carrying value of 2,500 on that date. So now let's read the question. The question is, what is the carrying value of the machinery shown in the statement of financial position at the end of the year on 31st December? So this means that after adjusting everything, after adjusting for the disposal, after adjusting for the new machinery, what is now the carrying value at the end? So do you think that we should again depreciate the 2,500 disposal the asset to calculate the depreciation for the 6 months in the current year when it was in the business? No, I can't do that, because this figure has already been depreciated for the current year. This is the post depreciation figure for the current year. Now this is a very interesting question. First of all, let's find out the carrying value or the depreciation for the new asset, right? Let's keep that aside first. So the new asset, it was purchased on 30th June and it had a value of 6,000. So let's calculate depreciation on that first, the new one, right? 6,000 was the cost, and the depreciation rate is 20%, but we won't be charging it for the full year since it was bought on 30th June. So from July to December, only for 6 months it remained in the business in the first year. So that would be $600 of depreciation. This means that the carrying value would be 6,000 minus 600, 5,400, right, in the first year. Okay, so whatever the carrying value comes for the remaining old assets, we have to add 5,400 to it. Now let's begin with the calculation of the remaining assets that were already there in the business, and from them how should we subtract the 2,500 asset being disposed of. Now can we conclude that from January to June this asset existed in the business, but from July till December it did not, because it was sold on 30th June. So this means that if I charge the depreciation in two halves, in two parts, from January till June, the value of the asset was 20,000. Okay, so on 20,000, if I want to charge it the depreciation only for 6 months, that would be 20% into 6 upon 12. That will be 2,000 for first 6 months only. Now can we also conclude that this 2,000 represents the depreciation being charged on this asset which I am disposing of on 30th June? Because this would have existed in this 20,000 value as it was the opening figure. So in the opening value, which consists of all the assets which were there in the business at the opening date, and also the one which I am disposing of on 30th June. I have charged depreciation on this asset and on all the assets that were there, right? So that was 2000. Now this includes the depreciation figure on this asset. Then what happened on from July till December, the remaining 6 months? What is the position now? Now in this 20,000, I now have to subtract the 2500 asset value, which I am disposing of, because now it won't be there in these 6 months. That would leave me with assets amounting to 17,500. Please keep in mind that I am not subtracting the 2000 value over here. I am subtracting the asset disposal value, and with this I am also subtracting its depreciation from the carrying value at the opening date. This will leave me with the value for those assets which remained in the business from July to December, right? The old remaining assets. Now on this value I will charge the depreciation 20%, but for the remaining 6 months only, and that will be 1750. Why did I do this is because as I wasn't given the opening net book value or the opening carrying value separately for the asset that is being disposed of on 30th June, so I couldn't, right? I couldn't find that value, and since it includes the depreciation charge, it is the post depreciation figures, so I just have to incorporate the current year depreciation charge on this asset as well, because I am charging monthly basis policy. So 6 months of depreciation would also have been charged on this asset. And how could I do this? I could only do this if I divide the carrying value in 2 halves. In first half this would have existed, so I can calculate the value like this. In this I have already incorporated the depreciation charge for the first 6 months on this asset as well. Then in the next 6 months it wouldn't have existed, so I have subtracted this from my carrying value at the beginning. So now let's see what is the situation. My opening net book value was 20,000. I have subtracted the 2,000 first half charge, and then I subtracted the 2,500 disposal value, so that I can calculate the depreciation on the remaining assets for the next 6 months, and that came out 1750. That's right. So 20,000 minus 2,000 first half depreciation minus 2,500 disposal asset minus 1750 would be 13750. This is the net book value of the remaining assets in the business. So 13,750 should be added to the 5,400 net book value figure of the new asset, which would give me a value of 19150 carrying value at the end of the year on 31st December. Right? Now let's move towards question number 6. Which statement describes a limitation of reconciliation and verification procedure? So only one would be the limitation. The other 3 won't be the limitation, or maybe they are the benefits. We don't know. Let's start. Let's read from option D. Option D says the totals shown in the trial balance do not always agree. Yes, this is true, that if the trial balance totals do not agree, so this makes us realize that there would be some errors in the T accounts or in the day books, that is in the books of original entries. There may be some posting errors, etc., etc. So that gives us a hint that go for verification procedures, go for reconciliation procedures. Either make a PLCA, make a sales ledger control account, make a bank reconciliation statement, and find out the differences. So this is a benefit. So this can't be a limitation. This is a good thing. Option C says bank transactions may be missing from the bank column in the cash book. What does this mean? This means that in case of bank reconciliation statements, if we haven't reported a transaction in the bank account, let's say bank charges or direct debit or standing order, so again by comparing the cash book and the bank statement, we can locate the causes of differences. The time due to timing issues or any other transaction can be located, and that can be fixed through reconciliation. So this is again a benefit. This is not a limitation. This should be done. Option C B says that errors of commission could be present in the books of account. Yes, this is one of the biggest limitation of um, control accounts, especially, and for reconciliation as well, that if there are some errors which are not revealed by the trial balance, which can't be revealed by the trial balance, they would also not be revealed by the reconciliation or verification procedures, right? As because of them the trial balance would also balance. So error of commission, error of omission, error of principal, etc., they, if they are there, they wouldn't be found, they couldn't be located. So this is a limitation. Option A says sometimes a sales ledger control account balance does not agree with the totals of the yes, sometimes it doesn't agree. So again, this gives us a hint to look for the errors and find out the differences and then correct them, locate them and correct them. So this is again a benefit of verification procedure. So this isn't correct. Option B is the right answer. Number 7, the following errors in the accounting records have been found and corrected. Okay, so they are corrected. The question is, we are also given with the gross profit for the year before correcting the errors, that was 60,200. The question is, what is the correct gross profit for the year? So we have to correct this figure. We might be adding something, we might be subtracting something, or we might not be doing something from this figure also. So let's read one by one. A purchase invoice for 250. A purchase invoice for 250 was omitted from the books of account. This means that purchases amounting to 250 are not recorded, so purchases are currently understated. Now in order to correct this error, I have to increase my purchases by 250, and if I do that, my cost of sales would also increase as purchases are added in the cost of sales along with opening inventory and carriage invoice. So cost will increase. So what will be the result of correcting this error? If my cost will increase, my profit will decrease. By recording purchases, my profit will decrease. So from 60,200, I have to subtract 250 to correct an increase in purchases. Number 2 is a sale for 120 to X was debited to the account of Y. So sales should be credited. Sales are being correctly credited. And instead of debiting X, the company, the business has debited Y. So how would this error be corrected? Y will be credited and X will be debited, as how this should have been done, right? This is an example of error of commission. Now, should this error affect the gross profit figure? No, it wouldn't, because we know that both are the trade receivables of the company, of the business, and trade receivables are not recorded in the statement of profit or loss. They are recorded in the statement of financial position. So this won't affect the gross profit figure. If the error would have been in sales account, an item that is there in the statement of profit or loss, that would have affected my gross profit figure. So from one account to another account, of course the total sales receivables, the total trade receivables won't change, but in the individual accounts this error has to be corrected. But this won't be used to correct the gross profit figure, as this correction doesn't involve any item that is recorded in the statement of profit or loss. Number 3 is the sales journal. Now sales journal, sales is recorded in statement of profit or loss. Now what happened? It was overcast by 100. If the sales journal is overcast, this means that the sales account would also have been overcast. Now if I want to reduce my sales, by correcting, I will be reducing my sales. So if sales decrease, my profit would also, my GP would also decrease. So I again have to subtract 100 from the gross profit figure. This would leave me with a correct gross profit of 59850. Question number 8. The bank statement of a business showed a credit balance of 3421. Credit balance means a positive balance. From the perspective of bank, we are a liability to the bank, right? So credit balance means a positive balance for the business. So it was 3421, which did not agree with the balance in the cash book, right? Further investigation revealed that a receipt entered in the cash book for 125 and a payment for 455 had not yet appeared on the bank statement. Further investigation revealed that a receipt entered in the cash book, that this item is present in the cash book for 125. What is this? This is uncredited deposits or uncredited bankings. they are present on the debit side of the cash book. This is the cash received in the business. The business has recorded it, but it hasn't been recorded by the bank yet. So these differences arise due to timing issues. And a payment represents an unpresented check which is present on the credit side of the cash book. We have recorded this payment, but it hasn't been yet. It says that it hasn't yet appeared on the bank statement, so due to again timing issues. Further it says the bank statement showed bank charges of 64. Now this is present in the bank statement but not in the cash book. And a credit transfer of 177. This is amount received in the bank from third parties. It could be dividend received, it could be interest received. So these two items are present on the bank statement but not in the cash book. The question also says that. Now let's read the question. Which balance was shown in the cash book before making the necessary changes and preparing a reconciliation statement? What is being asked? This is a very good question. We have to find out the unadjusted cash book balance. How can we arrive at this balance? If we can recall the format of bank reconciliation statement, right? If I just write that down quickly, if we start with balance as per bank statement and we add the uncredited deposits, we subtract the unpresented checks, we can arrive at the balance as per not the unadjusted cash book but the updated or adjusted cash book. Let's do this first and then we'll move towards the unadjusted balance. Okay, so what is the balance as per updated as per bank statement? That was given to us 3421, and there were some uncredited deposits amounting to 125 that will be added, and there were some unpresented checks amounting to 455, so they will be subtracted, right? 3421 plus 125 minus 455, that would give me 3091. What is this? This is the balance as per updated cash book, but we don't want that. That, as you can see, that is already there in the answer, but this is not the correct answer. We want the cash book balance before making the necessary changes. Now if we have found this, we can easily go back to the opening balance of the cash book, right? Let's make an updated cash book over here, right? Updated cash book. Now 3091 is the balance carried down, right? It would have been the balance carried down after correcting all the errors. Now the balance brought down could fall on the debit side or on the credit side. We have to find that out. How would I do that? 3091 is the updated balance, that is not the opening balance. Let's make that clear. That will go in the statement of financial position, but this is not what is being asked. This is after the corrections. We want the one that is before the corrections. And what have we corrected in this updated cash book? The items that are there in the bank statement but not present in the cash book would appear in the updated cash book, right? So how many items are there in the question? 2. Bank charges of 64, where are they recorded? On the credit side, right? Bank charges is an expense, so that is credited in the updated cash book, and credit transfer being an income will be debited. So 177 credit transfer would be debited to show an income, to show an inflow of cash, right? So now as you can see that 3091 plus 64 minus 177, the difference would definitely fall on the debit side, which would give me an opening value of 2978. That will be my opening cash book balance before the preparation of updated cash book, before the preparation of bank reconciliation statement, right? So that is option A. This was a very good question, as we revised almost all of the bank reconciliation statement in it. Now question number 9, which statements describe the benefits of preparing control accounts? Okay, let's quickly revise the benefits of control accounts. We know that control accounts act as an independent internal check on the accuracy of the ledger balances, right? So that we can locate the differences, we can correct the differences in both the ledgers and the control accounts if they don't agree. right, as it facilitates in the location of errors. Similarly, they are helpful to safeguard against the fraudulent entries or activities that are going on in the business between employees, and it quickly provides the figures, or it facilitates in the preparation of financial statements, as it provides the trade receivables and trade payables figure. Similarly, it is useful to calculate missing financial statement items, for instance, especially in case of ratios. If we are given with the opening and closing, for instance, trade receivables and some other entries, we can find out the sales during the year. So let's read the question now, that which statements best describe the benefits of preparing control accounts. The first is, it assists in detection of frauds. Yes, it does. As usually, the ones preparing the sales ledger and the ones preparing the sales ledger control account are two different individuals, so fraud can be detected. Similarly, number 2 says, it assists in finding errors of original entry. No, errors of original entry, this is the biggest limitation of control accounts, as the errors present, if the errors that do not affect the trial balance are present in the accounts, they won't be revealed by the control accounts. So this is a similar question to what we have done earlier, which was in question number 6. So this isn't a benefit, this is a limitation. Number 3 says, assist in finding transposition errors. Okay, yes, this is true. The transposition errors, for instance, if for instance a transaction was $678 or $678, and if that has been recorded in one account as 678 but in another account as 768, so that can be located through the preparation of control accounts, as the two amounts won't balance. Number 4 is assist in preparation of financial statements. Yes, that we have already seen, that it provides the figures for trade receivables and trade payables. So this is a benefit. So which is 1, 3 and 4, option C. Number 10, a trade payable for 720 transferred from purchases ledger has been entered on the wrong side of the sales ledger control account. What are they talking about? They are talking about contra entry. Sometimes a party can be a trade payable and a trade receivable for the business. So we settle the common amount between the two balances as a contra set off by making an entry as we debit the purchases ledger control account and we credit the sales ledger control account. The difference could either be a trade payable or could be a trade receivable. So what happened in the question is, a trade payable for 720 transferred from purchases ledger has been entered on the wrong side of the sales ledger control account. Now, what would be the wrong side? It is always entered on the credit side. In SLCA, a contra set off is recorded on the credit side, but this hasn't been done. We have recorded this value on the debit side. This is the error. The question further says that the sales ledger control account has a closing balance of $92,460 before correcting the transfer. An allowance for irrecoverable debts of $1,000 is to be made. What is the correct balance on the sales ledger control account? First of all, we have to correct this error. This 720 shouldn't have been recorded on the debit side, it should have been recorded on the credit side. But since this has happened now, I have to correct this error. And how do I do that? I now have to make an entry on the correct side but with the double amount. Why the double amount? I will now credit my SLCA with 720 plus 720, 1440. As the breakup of this 1440, 720 will eliminate the effect of the wrong entry on the wrong side, and the another 720 will establish the correct entry on the correct side. So this is how it will be corrected. The question also said that the closing balance before correcting the transfer was $92,460. Now, if this doesn't mean that this is the carried down. Of course, it was the carried down, but before correcting the error. So we will assume that this was the brought down balance, as it represents the situation before correcting this error. So now after correcting the error, we left with another balance, the corrected balance. So we start with the uncorrected balance, then we make the correction so that we arrive at the correct sales ledger control account balance. But should I include the allowance for irrecoverable debts of 1,000 in SLCA? No, I won't. Do I make an entry of allowance for irrecoverable debts in my trade receivables account? No. Allowance for irrecoverable debts are directly recorded as, for instance, allowance for irrecoverable debts debit to a statement of profit or loss credit. We don't record the allowance for irrecoverable debts in debtors account. If an entry is not being recorded in the debtors account, it will not appear in the sales ledger control account as well. Why? Because this value was just an estimation. We don't record this for any particular debtor account in any particular debtor's account. So this will never appear in sales ledger control account as well. Of course, irrecoverable debts, they do appear on the credit side of SLCA, but not the allowance. So now let's calculate the CD. That would be 92,460 minus 1440. Okay, that this won't be used for calculation. I just wrote that for the purpose of understanding that that this has happened. Now this, we were left with this balance, and after making the correction, the carried down figure would be 92460 minus 1440, so 91020, option B. Question number 11. After preparing the draft statement of profit or loss, it was discovered that the purchase of an office computer had been incorrectly recorded in the purchases account. Purchase of an office computer was a capital expenditure. It should have been recorded in its own account as it is a non-current asset. But this has been recorded in the purchases account. Purchase account is a type of an expense account. So what type of error is this? This is an error of principle. The question is, what will the effect of correcting this error be on cost of sales and the profit for the year? You don't have to tell the effect of the error, but the correction of this error. Now when I will correct this error, I will of course have to eliminate the amount from my purchases account, as purchases currently are being overstated with this value. So the correction would decrease the purchases. If my purchases will decrease, my cost of sales would also decrease, and if cost decreases, I know that my profit, GP, will increase. Profit for the year or gross profit, both will increase. So cost of sales will decrease and profit will increase. Cost of sales decrease and profit increase, so that will be option B. Question number 12. The draft profit for a business was 64,000 before the following information was taken into account. We have 2 points. The question is, what is the revised profit for the period? So all the adjustment will be done in this 64,000 value. The first one is, an allowance for irrecoverable debts was maintained at 2% of trade receivables. The total of trade receivables was 150,000 at the beginning and 220,000 at the end of the period. Okay, let's stop here and do the calculation. We have to adjust the allowance for irrecoverable debts in the current year. We haven't incorporated the allowance in the 64,000 value. So how do we do this? We know that only the difference between the opening and closing allowance for irrecoverable debts is recorded in the statement of profit or loss, and that we have to do. We are not given with the opening allowance, we are given with the opening trade receivables and the percentage. So can't I find out the opening trade receivables, opening allowance for irrecoverable debts? I can, of course, by applying 2% on 150,000. So 150,000 into 2% would be 3,000. This was the opening allowance for irrecoverable debts. What is the closing? 220,000 into 2%. So that will be 4,400. This is the CD value. This is the brought down value. Is there an increase or decrease? There is an increase during the year on allowance for irrecoverable debts by 1,400. An increase is recorded as an expense. So I have to record this 1,400 as an expense. And if I do that, my gross profit will decrease by, my draft profit will decrease by 1,400, as an expense wasn't recorded previously and it is now being recorded. Second adjustment is, on the last day of the period, 4,000 was recovered from trade receivables that had been written off as irrecoverable. Oh wow. What is this? This is irrecoverable debts recovered, previously written off as an irrecoverable debt, are now being recovered. So how do we record this? 4,000 is being received, so bank will be debited. and irrecoverable debts recovered will be credited. This is an income account. And income is recorded in statement of profit or loss, that will affect my profit. And if income is being recorded and income is being increased, so that will also increase my draft profit by 4,000. So 64,000 minus 1,400 plus 4,000 would be 66,600, option D. Please keep in mind that if such questions come, then only those items that are recorded in statement of profit or loss will impact the profit, only those, right? The items that are recorded in statement of financial position won't impact my draft profit. Number 13, a sole trader doesn't keep a complete set of books of account. He believes that a staff member has stolen some cash. Okay. So first of all, he didn't keep a full set of accounts. Now some cash has also been stolen. Okay. Now the question is, which items will not be needed to calculate the amount missing? What is being stolen? Some cash has been stolen. This means that if he had prepared a cash account, he could, or if he still makes a cash account, he can find out the missing amount. So let's conclude that a cash account is necessary for finding out the amount missing. So all the transactions that can be recorded in the cash account will be needed to find out the amount missing, right? Now let's read one by one. Cash in hand at the beginning and at the end of the year. Will this information be needed? Of course it will be needed. The brought down will be needed. The carried down will also be needed. So yes, this is an essential information. Number 2, we have to find out that which is not needed. Okay. So number 2 is owner's drawings taken from the bank. Owner's drawings taken from the bank. How do we record this? Drawings by the owner, debit, and bank, if it is being taken out of bank, so bank will be credited. So will this piece of information be required? No, as it doesn't involve cash. Okay, so this won't be used to find out the cash amount missing. Okay. Number 3 is checks received from customers. Checks received from customers. How would this have been recorded? Bank debit, as it is bank check is being received, and my debtor would have been credited. Again, does this involve cash account? No, it doesn't. So it won't be used to prepare the cash account and to then find out the amount missing. Last is totals of cash sales and cash purchases. Yes, that is necessary. Cash sales means cash account would have been debited with the cash sales, and cash purchases means cash account would have been credited by the purchases. So this will be required. So 1 and 4 only. Okay, if the cash is missing, so only the items that will go through the cash account will be required to find out the missing value, which will be the balancing value in this case. Number 14, a trader sells goods at a uniform markup of 20%. Okay, markup is on cost. This means that if profit is 20%, my selling price would be 120% and the cost would be 100 then. The following information is available for the year ended 31st December. We are given with the inventory at first, so opening inventory, closing inventory, purchases, carriage inwards, outwards, goods taken for use at selling price. Let's read the question. What was the value of cost of sales for the year ended? We are given with almost all the information to calculate cost of sales if we start with the opening inventory and we do all the adjustment. So let's do this first. Opening inventory is 1780, that will be used. Then purchases are also added, so purchases will be added amounting to 23,400, right? And carriage inwards are also there, so 700 of carriage inwards will also be added. And opening inventory is used, closing inventory will be subtracted in the end, purchases are used, carriage inwards. Do we also have carriage outwards over here? No, carriage outwards are recorded as an expense after the gross profit and other expenses. They are not part of the cost of sales. Okay, since it is incurred for delivering goods to the customers, not bringing the goods into the business, so that is not part of cost of sales. So 450 is given just to confuse you. Ignore that. And we know that we subtract the inventory drawings by the owner. But since we are calculating cost of sales, we have to take everything at cost, not at selling price. Inventory drawings are given at selling price. That is why we were given with the markup, because we now have to convert the inventory drawings from selling price to cost. We have to bring them to cost. Please keep in mind that only that items which are at cost are used in cost of sales. Okay, so inventory drawings will also be subtracted, but on their cost, not on their selling price. How do we calculate the cost? We know that cost is unknown, so 100 upon what we already know, that is, we know the selling price, upon 120 into 1800 value would be 1500. The cost of the goods taken by the owner as inventory drawings was 1500, and 1500 will be subtracted in cost of sales, not at selling price. We also subtract the closing inventory value, which was 2100. So this will leave us with 22280 as cost of sales. Okay, so carriage in outwards won't be used, and goods taken was for own use would also be used, but on cost, not on selling price. Number 15. Both partners in a business have a credit balance on their current account. So this is good. Credit balance is should be there in the current account. How does the inclusion of interest on drawings affect the financial statements of partnership? Okay, inclusion of interest on drawings. Interest on drawings. If I prepare the profit and loss or statement of profit or loss appropriation account, so in after calculating profit for the year, we know that we add interest on drawings, right? Because this is taken by the partners, it is added in the profit. Interest on capital and salaries are subtracted because they are given out of the profits to the partners. So interest on drawings, and we can see that since it is being added, this increases my profit. So profit gets increased with this. We have to find out its impact on two things, on current account balance and on the shares of residual profits. On current account balance, on current account, the partners current account, where do I record the interest on drawings? On the debit side. Interest on drawings, share of loss, that these items which decreases the current account balance, they are recorded on the debit side. So the inclusion of interest on drawings would reduce the current account balance. Okay, and that I can see in option A and option B. How will this impact the share of residual profit? The inclusion of interest on drawings, since it is being added to the profit for the year, so more will be there for the partners to be distributed between them, so it increases the share of residual profits. So that is B. One item will be decreased, one item will be increased through the inclusion of interest on drawings. Question number 16. Vikram and Walter are in partnership but have not made any partnership agreement. Okay, so we know that if there is no partnership agreement, there are certain points, and in that case partnership agreement of act of 1890 is followed, and under that act profits and losses are shared equally. There is no interest on capital, no interest on drawings, no salaries to the partners, and if the partner has given loan to the partnership, interest on that loan is paid at the rate of 5%. Moreover, there is one more point, that partners contribute capital equally, right? If the question is silent, so we do assume that partners are contributing equally in case of no partnership agreement. Further, it says the net assets of the partnership at the end of the financial period total 180,000. What are net assets? Net assets are basically total assets minus total liabilities, which gives us capital. And in the case of partnership, capital consists of capital account plus the current account balances of the partners, right? So both of these will be the net assets for this business. Also, partners maintain capital and current accounts, right? So they are not just maintaining current or not just capital account, they are maintaining both. So net assets will be of capital and current account balances, right? Now the opening balances on the current accounts were: for Vikram it is 3200 credit, for Walter it's 6800 credit. For Vikram it's 3200 debit balance and credit balance. The profit of the partnership for the period before appropriation was 85,000. Vikram had provided a loan of 20,000 to the business. The question is, what is the balance on Vikram's capital account at the end of the period, right? So we have to do certain adjustments to find out Vikram's capital account balance. Total we know, but this total consists of capital account balance and current account balances for both. We want for Vikram only. Let's start with the current accounts of both the partners. For Vikram, it had a debit balance, so 3200 will be on the debit side. Then what else can go inside this T account? Vikram had provided a loan of 20,000 to the business. So in case of no partnership agreement, 5% interest is paid on any loan by partner to the business. That would be 1,000 interest. And where does this go? If we just quickly have a look at partner's current account format, so balance brought down could fall on either side. Profit share, anything that increases current account balances, that is credited. So similarly, profit share, interest on capital, interest on partner's loan is also credited. Bonus, salary, commission is also credited, whereas drawings, interest on drawings, share of loss is debited. So since this is being received by Vikram, that will also come on the credit side as 1,000. And then lastly, since there is no interest on drawings, there is no even drawings, no interest on capital, no salary, so we just have to divide the profit between the two partners. Now it was 85,000. This is profit for the partnership for the period. This is profit for the year. Interest has already been deducted from this profit. So now this will be distributed amongst the two partners in equal ratio. So for Vikram it will be 42,500, and same for Walter, 42,500. That will be on the credit side. So 42,500 plus 1,000 minus 3,200 will give me a carried down figure of 40,300. Right, so this is the CD figure. Out of 180,000, 40,300 is Vikram's current account balance. Now let's do the same for Walter as well. Walter balance brought down was on the credit side, 6,800. 6,800 will be on the credit side. Then there is no interest on loan. For Walter we just have to adjust the profit share, that is 42,500. This will give me a CD on the debit side, and that will be 49,300. So out of 180,000, now since net assets consisted of current account and capital account balances, now we are just left with one step, and that is to find out Vikram's capital account balance, right? So 180,000 consists of current account balances at the year end, said in the year end of the financial year. So Vikram's current account balances is 40,300 and Walter's is 49,300, plus it also consists of capital account balances of both the partners, and that those balances won't be different, since in the absence of partnership agreement partners contribute equally. So that would be X, that is capital investment by Vikram, and plus X, the same investment by Walter as well. So 180,000 minus 40,300 minus 49,300 is equals to 2x, and that would be 90,400 is equals to 2x. So x will be 45,200. Option B. Question number 17. Which row correctly shows an example of a capital reserve and an example of revenue reserve? So capital reserves, we know they are generated from non-trading activities, such as from any structural changes in a company, and revenue reserves are generated from trading activities, from profit related activities. So Capital reserves. In capital reserves, we have share premium, we have revaluation reserve, and in general reserve, we have retained earnings, we have general reserves, right? So capital reserve, no. General reserve is not a capital reserve. Retained earnings is also not. Revaluation reserve, yes, but over here share premium is not. So share premium, yes. General reserve, we also yes. Option D. Question number 18. On 1st January, a company makes a bonus issue of 10,000 ordinary shares of 0.5 each, and during the same year, it also makes a rights issue of 150,000 ordinary shares of 0.6 each. The question is, what is the effect of these in the statement of financial position on two things, on share capital and reserves, by how much will it increase, and on current assets, and how much by that will increase. Okay. We know that we don't raise any cash in bonus issue. It is always at the face value. So let's make an entry for that. The 10,000 ordinary shares, if they are being issued at 0.5, so the value of the share would be, the share capital raised would be 5,000. 10,000 into 0.5 is 5,000. So the double entry for bonus issue will be, it is financed from share premium. Priority is given to capital reserves. So share premium would be debited by 5,000, and my ordinary share capital would be credited by 5,000. So the impact of this would be that my share premium would decrease and my share capital would increase. We'll look at the impact in the end. Now let's find out for rights issue. How much am I raising from rights issue? The par value was 0.5, but I'm issuing it at a premium of 0.1. So in rights issue, bank is involved. Bank will be debited by 0.6 into 15,000, that will be 9,000, and my share capital will be credited with par 0.5 into 15,000, that would be 7,500, and share premium will also be credited by 1,500, that is 0.1 into 15,000. Now we have to tell the effect. So current assets, there's only one account or related to current assets, and that is bank, which will increase by 9,000 only in case of rights issue. So my answer could either be A or it could be B. It could be C. Now we have to see by how much capital reserves and share capital and reserves will increase. Right. So in my first transaction, I am increasing my share capital by 5,000, and I am reducing my share premium by 5,000 as well. Okay. Then in the second transaction, again I am increasing my share capital, so plus 7,500, and my share premium is also increasing by 1,500. Right. So let's total this. 5 plus 7,500, 12,500, and my share premium will reduce in the net figure would be a reduction of 3,500. So in total there is an net increase of 9,000. That is option A. Right. Question number 19. An accounting student made the following statements about the requirements of different users of the accounting information of a company. Okay, and the question is, which statements are correct? The government wants to assess the company's return on capital employed. The government? No. The government doesn't do that. Return on capital employed is basically a return on investment that is assessed by the investors in the company, by the shareholders. Basically, they want to see how much return they are getting on their investment. Government wants to see the profits for tax purposes. Okay, so this is wrong. Second is, suppliers wants to know if the company is financially stable. Yes, this is correct, so that they get an idea that whether their debts will be paid by the company on time or not, or whether the company will be continuing its operations in the future for orders, etc., etc. Number 3 is, managers use the information for planning and control purposes. This is also correct, that all of the information is financial information is used by managers for better planning and control, better decision making. Last is, lenders want to know whether the business is able to pay dividends. Now, why would the lenders want to know that? Again, dividends are paid to the shareholders as a return on investment, so lenders doesn't have anything to do with that. Lenders, again, if they are suppliers or if they are someone from whom the company has taken a loan, so they would want to know the financial position of the business, the profits of the business, and whether the business is making a profit, whether their loan will be repaid, whether the interest payments will be made regularly or not. So this is also incorrect. So the correct ones are only 2 and 3, option D. Number 20. What could improve the current ratio of a sole trader? What is the formula of current ratio? Current assets upon current liabilities. So how can this ratio be improved? Either my current assets increase or my current liabilities decrease. So keep this in mind. Now let's read the options. Let's start from A. First is delaying payments to credit suppliers. Now it may seem that delaying payment to credit supplier may improve the bank position or the cash position of the business, as it will be retained in the business for a longer time. So as my bank will improve, so will my liabilities will increase. It will remain in the business. My trade payables, my debt. There is an increase in bank balance, not an increase basically, but cash will be retained for a longer time. But similarly, my liabilities won't also be paid in that time, so they will also exist. So it won't improve the ratio. One of the either two should happen. This is not right. Second is encouraging credit customers to pay promptly. Okay, so if we are doing that, that they are making a payment on time, so again my bank or cash position would improve, but at the same time my debtors would also reduce. So an increase in asset and a decrease in asset as well simultaneously doesn't improve my current ratio, as there is no change in current assets. So this is also not right. Option C says purchasing all inventory on credit. Oh my god, no. If you are purchasing all inventory on credit, so again inventory current asset will increase, but your liability, that is your trade payables, would also increase. So an increase in asset is offset by an increase in liability. There is no improvement in current ratio again. Last is reducing monthly cash drawings. Does this strategy result in any change in liabilities? No. There is only change in current assets, and my cash position will improve. The sole trader's cash position will improve. So there is only an increase in current assets and there is no change in current liabilities. Now this will result in an improvement in my current ratio, right? In all of the above statements, both assets and liabilities were being affected, or even if assets are being affected, one is increasing, one is decreasing, that will offset the ratio, the increase or decrease. So only in option D I can see an increase in my current assets. Question number 21. Which ratios will identify the highest profit for the year for a business? Okay, so in this question we are talking about two types of ratios: expenses to revenue ratio and non-current assets turnover ratio. Let's quickly have a look at the two, that what is operating expenses or expenses to revenue ratio. It is basically calculated by dividing operating expenses with non-net sales times 100, so it comes in percentage form. And a lower operating expenses ratio is better, as a higher ratio leaves a small amount of revenue for covering financial expenses and tax for companies. So which is better? A lower operating expenses ratio is better. So while reading the options, we will keep this in mind, that in which option can I find this. And the second is non-current asset turnover. What does this represent? It represents the efficiency with which a business uses its non-current assets to generate revenue for the business, and it is calculated by net revenue divided by total net book value of the non-current assets. Now which amongst this is better? A high rate indicates that business is efficiently using its non-current assets, and a low rate indicates that business is not usually using its non-current assets efficiently, but again it varies from business to business. For instance, for manufacturing types of businesses, they have more investment in plant and machinery, so they want to see the higher return also. But in retail business, most investment is in the current assets, right, the inventory, and they have lower investment in plant and machinery, so they are not much concerned about non-current asset turnover, rather inventory turnover. So keeping this information in mind, now let's read the options one by one. In option 1, expenses to revenue ratio is 18%, B is also 18, in C it is 20%, and in D it is 20%. So we have just seen that a lower expenses to revenue ratio is better, so the answer could be A or B. Second is non-current asset turnover. So this represents the efficiency by which we are using the non-current assets to generate revenue, so it should be high. And where can I see a high ratio? In A is 4 times, B is 6 times, 4 and 6 again. So it should be more. So it could be 6 times and 6 times. But since we have already cancelled that, D can't be the right answer as it has more expenses to revenue ratio. So it is option B. The expenses to revenue ratio should be low and non-current asset turnover should be high. Number 22. A business provides the following information at 31st March. The question is, what is the asset test ratio? Okay, asset test ratio is basically, it is also called a quick ratio. And why is it called a quick ratio? As it shows the most liquid assets that the business has by not taking into account inventory. So how is that calculated? There are two ways. Either we take all the current assets in numerator and we subtract the closing inventory from it, and then we divide it by current liabilities, or we take all the current assets except inventory over here, and if I haven't taken inventory over here, I don't have to subtract it again. So let's do the second method, that I don't take inventory in account. So trade receivables will be used, 785,000 plus cash and cash equivalents, another current asset 15,000, divided by 365,000 current liabilities, and another other payable 85,000 current liabilities, right? I am not adding inventory here, so I am not subtracting it again. If I am adding inventory, so I'll have to subtract it again, so net impact would be 0. So this method saves time. So that would be 800,000 upon 450,000. So my asset test ratio would be 1.777778. That would be 1.78:1. Number 23. Moving towards costing now. A company pays its employees 6.8 per hour for a basic 40-hour week. Okay, and an overtime is paid at 50%. Or 50% is payable together with there's a bonus also of 0.25 per unit for all units produced over 350, and employees are also guaranteed a weekly wage of 330. That if you, after calculating all of this, if you are still earning less, so we'll give you $330. No employee is paid less than 330. Now what did the employee do? One employee worked 45 hours last week and produced 410 units. What was his gross pay? So we will calculate it using three things. First of all, his basic pay, that would be for 40-hour week. So 40 hours into the rate, basic rate is $6.8. That will be $272. Then he was also paid overtime, and overtime premium is payable of 50%, right? 50% above 6.8, not 50% of 6.8. That will be a lower figure. No, premium is always paid at more rate than the basic rate. So 6.8 was the basic, $6.8 into 150%, right? That would be $10.2. Wow. So overtime is $10.2. And how many hours did he work above 40 hours? He worked 5 hours more. So overtime is on hours, and that would be $51. And lastly, he was also paid a bonus that was on units produced above 350. And how many did he produce above 350? 410 minus 350, 60 units were produced extra, and that was paid at a 0.25 rate per unit. So into $0.25 that would be $15, right? So let's total this. This would be $338, which is above the guaranteed weekly wage. So he will be paid $338, option B. 24. When are unit costing and job costing principles applied? So there are two. These are two different costing techniques. So unit costing basically determines the total cost per unit of a product or service, and it is commonly used in industries producing identical, right, identical or same goods, which is in a continuous process. Okay, so this is a differentiating feature between the two. For instance, manufacturing cement or shoes, etc. However, job costing is usually done for special orders. For that particular order, if I make some changes to customize the order, so I will use job costing for that order. It is not for continuous production, it is for a special order. So unit costing is in continuous operations, yes, but job costing isn't. Unit costing again in continuous operations, and job costing is for a special order, so option B. Moving towards question number 25. A hotel provided the following information for a 30-day period. Okay, so there is some information. The question is, what are the average payroll and cleaning costs per occupied bed per day? So we have two categories, rooms with 2 beds and rooms with 1 bed. And we have in total such rooms with 2 beds, we have 180. Out of 180, 150 are occupied per day on average. And out of 60 rooms with 1 bed, 50 rooms are occupied on average per day. Number of guests in period, currently 5,250 guests are there in the hotel, and their average length of stay is 2 days, and the total payroll and cleaning costs are also given to us. We have to find out the average cost per occupied bed per day. Now we have to use some calculation to find out the answer, and the calculation is hidden in the question itself. So we know, first of all, that we have to divide $300,000 of cost with let's write it over here, $300,000 of cost with something. Now what is that something? That will be in two parts, because we have two categories, rooms with 2 beds and rooms with 1 bed. So first of all, let's make this clear that 180 and 160 shouldn't be used for calculation, because not all of the rooms are occupied, only these rooms are occupied, so these figures should be used. So 150 rooms with 2 beds are occupied, and similarly 50 rooms with 1 bed are occupied. As the question says, cost per occupied, so occupied I have taken 150 and 50 beds. How many beds? In 150 rooms there are 2 beds, and in 50 rooms there is just 1 bed. So occupied bed per day. How many days are there in a month? It was given for a 30-day period, so both will be multiplied by 30 into 30. This information, that 5,250 guests and their average length of stay is 2 days, doesn't matter over here, because we have to find out the answer as per occupied bed per day, and the information was for 30 days. So for 1 month, right, we have to find out the answer relating to per day. So that will be $300,000 divided by 10,500. That would be 28.57. Number 26. Which two factors would mean that fixed overheads are underabsorbed? Okay, so when fixed overheads are underabsorbed, there are two situations when fixed overheads could be underabsorbed, and that would be if my actual overheads are more than my budgeted or my absorbed overheads. And situation number 2 is if my actual production is less than my budgeted production. Now in production there could be production of units, or it can be in terms of activity, for instance machine hours, labor hours, etc. So we have to look for two of these. So if actual hours worked, right, actual hours means if actual activity in this category, this is falling, if actual hours worked are less than the budgeted hours, yes, this is right. That if there will be, if actual production will be less than budgeted production, so of course actual hours worked will also be less than the budgeted hours, so this is right. Second is actual hours worked are more than the budgeted, no, that is for over absorption. Third, actual output is less than the budgeted output, so yes, actual production is less than the budgeted production, this is also correct. And fourth is wrong again because it is more than the budgeted output, so 1 and 3 A. 27. A company has a positive margin of safety. How do we calculate margin of safety? It is calculated by using the formula budgeted slash, it can also be actual, so the information can also be given, level of sales or in units minus the break even sales or in units, right? So if the answer over here is in sales, so let's assume it is sales. So we have to, now when can it be positive? The answer can only be positive if budgeted or actual sales are more and break-even sales are less. So the answer would be positive. Now let's read the options. Let's start from option D, that budgeted sales are greater than the actual sales. Now we don't compare budgeted with actual, we compare budgeted or actual with break-even. So this option is incorrect. Break-even sales are greater than actual sales. Now if this is happening, so that the margin of safety would be negative. This is also incorrect. Option B is actual sales. Actual sales are greater than the budgeted sales. Again, actual is being compared with budgeted. No, we want it to be compared with break-even. So no. A is actual sales. Now actual sales are greater than the break-even sales. Yes, that is when my margin of safety would be positive. 28. A company makes 3 products X, Y, and Z, for which details per unit are as follows. Right, we have selling price, direct material cost, and direct labor in hours, not the cost. Now direct labor rate is $8 per hour, and direct labor hours are limited. In which order should the products be ranked to achieve the maximum profit with the available labor hours? Right. So we know that we base our decision on not on contribution but contribution per limiting factor, and for that we still have to find out contribution per unit. For contribution per unit, we subtract all the variable costs from the selling price. So selling price minus direct material minus labor cost. Labor cost isn't given to us directly, we have to find this out. So if 0.5 hours are used for X and the rate per hour is 8, so 0.5 into 8 would be $4, the cost, labor cost, right, per unit. And for Y, again multiply it by 0.5, multiply it with $8, so it will be 16, the cost will be 16, and again multiply it with 8, so 2.5 into 8 would be $20. Now we can find out the contribution per unit. For X, 18 minus 4 minus 4, that would be 10. For Y, it is 35 minus 5 minus 16, that is 14. And for Z, 50 minus 5 minus 25, so 25. Now contribution per limiting factor. The limiting factor was direct labor hours. So in this contribution per limiting factor, we divide the contribution with the limiting factor, and that is hours per unit. So 10 will be divided by 0.5, 14 will be divided by 2 hours, and 25 will be divided by 2.5 hours, right? We will be using the limiting factor, which is hours, 0.5, 2 and 2.5. So 10 divided by 0.5, that is 20. 14 divided by 2, 7. 25 divided by 2.5, 10. So now we will do the ranking, that the one producing the highest contribution per limiting factor, it is X, then secondly Z, and then Y. So the order in which they will be produced is first X, so X is here, and it is also here, then z, not y, and then y, right? So option D. 29. Interesting question. The details of a planned college course are as follows. Okay, very nice. We have course fee per student. So what the college will be receiving, this is like, for instance, revenue or selling price per student. Then we have variable cost, course cost per student, and we have total fixed cost of the course. Okay, so this is per unit, these two are per unit, and this is in total. The question is, the budgeted number of students is 10. However, if a lower fees is charged, 20 students are likely to take the course, right? So if I charge lower than 100, I am estimating that 20 students would 20 students would take the course. The question is, how much should the course fee of 100 be reduced by to earn the same total profit from 10 students as from 20 students? So for that, I have to find out that how much can I earn from 20 students if I reduce my selling price. But for that to happen, first of all, I have to find out the profit. How much can I earn? That is my profit if I charge the same fees to my 10 students. So let's begin. First of all, we'll find the profit, and the profit would be, in this case, we are using, if you're using marginal costing, yes. So contribution per unit multiplied by the units, or in this case multiplied by the number of students, minus fixed cost will give me my profit. So selling price is 100, selling price minus variable cost, that is 20. This will give me contribution per unit multiplied by 10 students. So number of units or number of students will be multiplied with this, minus my fixed cost, that is the total fixed cost, and that is $480. This will give me a profit of $320 if I'm charging $100. Now I want to see that what would be the selling price, the reduced selling price, if I want to take 20 students but earning the same profit as this, which is $320. So how can I find this? I have to keep my selling price now unknown, because I am looking for the reduced selling price, but I know that profit should be same, which is $320. So if I want to earn the same profit, $320, now this is unknown, profit is unknown, and profit is known, selling price is unknown. So what would be the selling price? That is now unknown, minus variable cost won't change, minus 20 into 20 students now. Okay, and the fixed cost would also remain unchanged, minus 480. So the new selling price would be 320 plus 480 divided by 20 plus 20. My new, or should I say my reduced selling price, should be $60 in order to attract the 10 students that I want and earning the same profit. So that is, the question was, by how much will it be reduced? So it will reduce by, the previous one was 100, the new is 60, so it should be reduced by $40 in order to earn the same profit from 10 students as from 20 students. So option C. Last, this is usually the last question. Which statement applies for CVP, cost volume profit analysis? Let's start from A. Fixed cost per unit stay the same over a period. No, that is not true. Fixed cost doesn't stay same for a period. Per unit, in total it remains the same. So this is incorrect. Option B is, inventory levels change over a period. No, they don't, because we assume that all the inventory that is produced is also sold, so there is no closing inventory. C is, selling price per unit stays the same over a period. Yes, this is right, that even variable cost per unit is also assumed to stay the same. And last is, variable cost per unit change over a period. So no. Fixed cost in total remains the same. Variable cost in selling price per unit remains the same. So option C is correct. Okay, so alhamdulillah, we are done with this paper as well. I hope it was helpful. Let me know in the comments section if you don't get an explanation for any MCQ. I'll try to explain it again in the comments. And that's it.